I'll be talking about bases, good bases and bad bases, but I always like to start these off with a little quiz. I noticed that almost everyone raised your hand that you'd been to a level 2 before, so you should be able to recognize what type of base pattern you see here. Who can tell me what type of base pattern you see? Cup with handle, right. Now, how many people would buy this stock breaking out on that week? You would? 3 or 4 people. Anybody recall trading this, trying to trade it? Anybody know what that is? Say again? No, it's not. Let's see what it is. That's a cup with handle that everyone got. That was Tennessee Coal back in 1899. So I always like to see how honest everyone is to start off. Everyone's honest, so we're good. All right, so I like to bring along these old charts. This is from the project that Charles and I have been working on for a number of years. We probably started about 5 or 6 years ago. And it's always fun to share, and it really shows the point of what we're going to be studying today is the way the market really works. It's based off of history. History just repeats itself because the market moves are based off of human emotion, fear, greed, and hope. And that doesn't change. It was around 100 years ago. It's going to be around 100 years after we're all gone. So that's very important to keep in the back of your mind. As we're studying things, we're studying reality. Every year we just see what stocks went up the most. We study them at the very beginning of the move, and then we study how they topped. And we come up with rules of how to get out of the top and try to get in at the beginning of the move. Everything in your workbooks, that's what it's based off of, just reality. And so there's a lot to learn. And just a little bit of history on how we came up with these charts. A number of years ago, we were studying the bubble bursting. The technology burst in March of 2000, and then we were looking at the obvious similarities between the 1929 crash. And we were looking around for charts to use to study precedent analysis, which is what everything is based off of, and we couldn't find a database. So if you're Bill O'Neill and you want something, you build it. And so he hired a team of people that Charles and I worked with, and we got all the old newspapers from the 1880s, and they entered in the stock tables, every stock, price, high, low, close, and volume. Needless to say, it was very expensive, very tedious, and you're seeing the results of this. So Charles and I were lucky enough to kind of head up that project, and so we saw everything from the 1880s through the 1950s that we just don't think anyone else has out there because we tried to buy it rather than build it. So we've included these in your workbook, a few of these old ones that we didn't have before. But let's just take a look at these now before we get into your workbook. When you look at a chart, you want to learn something from it. Now, whether you look at 10 charts in a day or 1,000 charts in a day, every single chart that you look at, you should try to gather some information, and you're just putting it in the back of your mind. And that's what we do at the firm. That's what Bill does. If you talk to him, he'll say, oh, this reminds me just, like AOL in 98 or Fairchild back in 1960. Or, Chrysler in 62, he's able to do that. And those of us at the firm, after you've been doing it for a while, you can start building that memory bank. And until you get to the point where you can actually recognize and say, this looks exactly like this other chart, what you can do is see similar patterns and say, I know I've seen this before and I know how this plays out, either good or bad. And that's what you should be doing. Every chart that you look at, try to learn something from it. So let's try to gather some information off of this chart. What do you see? I see a definite character change. You have this run up here, then you had a definite character during this entire move, and then at this point in time, the character changes, and you have a nice run up here. So going back, you have one character, different character, and then another character. So this is a rapid advance. That's the character there. What would you say the character is from here? Well, it is sideways, but let's look at these numbers. I'll blow it up and make it easier. 46 down to 14. What would you call that? Wide and loose, exactly. This is a classic definition of wide and loose. It's wide movements. Look at this spread here. There's a wide spread from the top to the bottom, and the overall structure is loose. It's not tight. You don't see a lot of tight areas where we'll see over here, and we'll study that in a moment. You've got a big structure here. What would you call this structure here? I would call it maybe a double bottom, one bottom, two bottoms, but it's too deep to really be buying. So you're not going to be buying it, so it doesn't work out. Then you have another structure here. Well, what's this? A cup with handle, but notice it's very V-shaped, which we know is a core characteristic, and once again, it's deep. It's a little bit better, more constructive than this. It's tightening up a little bit. Then you have something very interesting. You have this kind of giant cup with handle, and within that pattern, you see a small cup with handle. This is something very important. This is the type of thing that you would be putting in your memory bank. You want to be looking for this, because this happens in a lot of our model books. Okay, you've got a large base, and then you'll have a small base within that. So that's a positive characteristic. So that's what you're taking away from this particular stock. You've got a large cup with handle, and then the small one. And notice this is tight. Okay, this area in here, these weeks, closing almost unchanged, that's tight. Well, what does that mean? It means that people are finally settling in on a price. Okay? Before, they didn't know whether to pay $31 or $17. It's all over the place. But now it's really consolidating. People are accumulating shares. That's a positive sign. That's something we see in model book stocks all the time. Areas of tightness. And we typically like to see 3 or more. So if you were looking at this stock and thinking about trading it, you would be circling that on your chart, making a note of that that's very positive. Plus, it's a well-contained cup with handle. Then it breaks out right there, and you have this really rapid advance up. And notice that it's a very clear change from this wide and loose to this tight area. Now, what does this pattern look like? It's clearly a cup and handle, right? But it looks just like this one over here, very similar. It has the same characteristic of it. So that's something that you'll notice when you're trading a stock is lots of times their bases will look very similar. Over here? Some people would look at this as a double bottom, meaning one bottom, two bottoms, and I wouldn't say that's wrong. I think Charles made a comment about how we'll look at bases differently. Many times, I'll be looking at a chart with Bill and I'll say, I see a cup with handle. He'll say, no, he sees a double bottom. But no one's right, no one's wrong. It's very much an art. The thing that you're trying to do is determine, is this stock under accumulation or not? And that we're going to get into in a couple slides of going through it week by week. The point here is it was wide and loose. It tightened up. It has a certain character, a nice trend. So it's looking like it's doing nothing wrong here. Builds another base just like this one. And then it goes into a climax, and Charles will go into that a little bit later of how to recognize that. So it's very classic, happening at the turn of the century. Let's take a look at another one. This is Bethlehem Steel. This is probably my favorite chart of all the stocks from the 1880s through the 1950s. And you'll notice, imagine, the market was closed during this whole time because of World War I. If you put yourself back in that time frame of, imagine your account is completely frozen, you can't buy, you can't sell. So a lot of stress would come out of that time frame. Then the stock comes out and it builds what we call a high tight flag. This is a rare chart pattern. The cup and handle that we just looked at, that happens all the time. A high tight flag does not happen very often. And when it does, it tends to have a really powerful move. So what is a high tight flag? You've got a flagpole and a flag. The flagpole is your run-up, and that's typically very short. Now, in your workbooks, Charles and I put in there all the definitions of all the patterns, all the minimum parameters, and everything that you need to be looking for. So you don't need to take notes on this. It's all in your workbook. It'll show you what you're looking for each one. But typically, the takeaway from a high tight flag is a rapid advance and then holding in tight. So your rapid advance is typically 100% or more, which you had in a very short period of time, and then it holds in. It's not giving up any ground. So what's going on there? Psychologically, there's some sort of shift, and people were willing to now, instead of paying $50, $60 for the stock, they're willing to sit with it with $150 and not really give up much ground on that stock. And maybe it'll fluctuate about 20% or so, sometimes a little more, depending really on the move. And that's very important. You want to study this area and say, does this look like it's not giving up much ground? You can expect it to fluctuate because the stock has run up so far, but you want kind of a tight feel. Then it gives you an opportunity to screw it up, like most stocks will do. Where is that? Okay, it's right on this week, right there. So let's look at that a little bit closer. Now, Charles mentioned that we both got an opportunity to work in Bill's office and learn a lot of things firsthand from him, so he'll probably pass on tidbits that he learned, and I'm going to try to pass on as many tidbits as I can. And one thing that he taught me one day was when you're in a stock and you buy it and you get shaken out and it sets itself back up, you need to handle it in a very particular way. I'll get into that in a moment. So imagine you're watching this stock, you recognize it's a high tide flag, you're waiting for your pivot. Your pivot is as it goes into new high ground over this flag area, which is right there. So you would draw a line right there, you would buy it right there. How many people would buy that stock right there? I would. You would have to buy it right there. Now, what are you doing when it comes in here? You're selling it. What do we always sell no matter what, 7-8%, no questions asked. That's the most that you can ever give up on a stock unless it gaps down on you. So you're out of it. Then it sets itself back up. Well, what does human nature tell you to do? Let's say you bought 1,000 shares over here and you just got burned. And then it's setting itself back up. Now it's reset its pivot. What would most people do? You bought 1,000 the first time. Avoid it, maybe buy 100 shares, 200 shares, something like that. That's the way everyone is wired. The way everyone's wired is typically wrong. And that's what Bill taught me. That if you're going to go back in a stock and it sets up and it's a proper buy point, you need to be aggressive. Okay? And so by being aggressive, you need to buy just a little bit more. So if you bought 1,000 shares the first time, you would want to buy just a little bit more, like 1,100 shares, just a tiny bit more. It's going to put you on the offensive side. And this is one of the best things that he taught me, and it's helped out a lot, because what happens if you didn't do that and then the stock does this? There was the move. So you buy it, you bought 1,000 shares, you're shaken out, and then you only buy 100 shares. And it goes up like this. You're kicking yourself the whole way. Psychologically, that's going to be devastating for you. Okay, you want to be honest with yourself. What we're dealing with is just psychology. Everything is just psychology in the market, whether it's understanding mass psychology, which is the price movement every day, a high, low, and close and volume. That's just what the masses have decided to do. Or understanding your own psychology. And that would be devastating for you. And you would make, if you're a normal person, you would make a lot of mistakes compensating for that mistake that you made there. So really make a note of that. If you buy a stock and you're shaken out of it and you're set up and it sets itself back up for a proper buy point, go back in and buy it and buy a little bit more. That is really worth its weight in gold. It's helped me out a tremendous amount. So then it builds another high tide flag. Now remember I said that high tide flags were really rare. So high tide flag on top of a high tide flag. Who can recall a recent stock where this happened? No, it was Taser a few years back, where you had a high tide flag on top of another high tide flag. And unfortunately, we hadn't studied this yet at the time the Taser was running, so we didn't have a precedent for it. But whenever you have a precedent for a stock, it gives you a roadmap. So that's our goal. Your goal is to try to create a memory bank of precedents. So if you came across this stock and you're in it, and then you're up here and it forms another one, you can go back and say, okay, well, that happened before in Taser, that happened in Bethlehem Steel, so I'm going to go ahead and buy more of it right here rather than be scared out of the stock. So it's very, very important to use precedent. Now let's move on to the last one of these old charts. This is General Motors in 1929. This is just to kind of give you a different picture. This is more of a kind of a steady, fast-growing stock, but it looks completely different than the Bethlehem Steel. So each stock has its own character, and this tends to build cups and handles, some of them bigger than others, cups and handles and saucers. So you want to be able to distinguish between a Bethlehem Steel and a General Motors, and there's a place in your portfolio for each one. You can't handle the volatility of having a portfolio filled with Bethlehem Steels, right? Your stomach won't handle it. You're not going to be able to do well. So you want to have stocks like this that are more steady in there as well, so you can handle one or two of those Bethlehem Steels in there. All right, so let's move into your workbook, and let's turn to page 7. We'll go over cups with handles. This is the one pattern that you have to have down. If you don't do anything else, get the cup and handle down backwards and forwards, because that's what the vast majority of our trades are based off of, cup with handle patterns. Okay, so you really want to get this one down. So what are you looking for? You're looking for this type of shape where it's rounded out. You don't want it to go straight down and straight back up. They would form more of a V. So you want it to look more like a U. And what does that do? It gives the stock a chance to kind of wear people out. And a stock will typically, scare people out or wear people out. It's very helpful if you have a wearing out phase where it's coming down, it's kind of going back and forth for a bit, getting rid of some people. If it goes down and straight back up, it doesn't get a chance to really shake people out or wear people out. So you want it rounding, you want it to be long enough. Typically, we look for 7 or more weeks from the beginning to the end. Sometimes you can have a 6-week cup with handle. But most of our base patterns tend to be about 13 weeks or so. Typically, the distance between an earnings report is where most of them will fall. And you want it to be in proportion with what the general market was doing. So if you've got a bad bear market, you can expect the cup and handle to be deeper. If you're in a steady uptrend and the market just goes through a little intermediate correction, you would be looking for a more shallow cup. Now, the handle portion is very important. You want that to be in the upper half. So this one you can just visually see. Here's your cup. This area is your handle. You can see that it's in your upper half. But if you don't know that for certain, if it's a little bit lower, you just do the math. What you do is you take the absolute high point in the base and the absolute low point, and you take the average. So you add them up and you divide it by 2. That's your midpoint of your cup. You do the same thing in the handle area. So you take your absolute high, absolute low, add those up, divide it by 2. So now you have the midpoint of the cup, midpoint of the handle, and you want the midpoint of the handle to be higher than the midpoint of the cup. And that's just something that we've found that more times than not, if the handle is in the lower half, it's either a little premature where it's going to run up and then form another handle, or it's more prone to failure. That does not mean that if you see a cup with handle have a low handle in it or a V shape, that it's not going to work. It's a negative characteristic. It's very important to just realize that, because you're going to see V-shaped cups work. You're going to see stocks with low handles or other faulty characteristics work. But what you're trying to do is look at the averages. What do most good bases look like? And that's what we're after. You want the probabilities of success in your favor. So let's take a look at how you actually buy one of these. This is on page 8. This is Chrysler back in 1962. This is probably my favorite chart during the 60s. There's a lot to learn from it. What we're going to focus on today is how to get in the stock. Now, how many people here use a standard pivot, meaning they draw a horizontal line from this point here, and they're buying it as it penetrates that? Okay. Now, how many people use alternative pivots already? Okay. I'll go over the differences. A standard pivot, and there's nothing wrong with continuing to use that. That is where you've got your cup with handle, and you draw your line through the high point of the handle. Once it penetrates that on volume, that's where you're going to be buying the stock. That's what you see in the newspaper most of the time. Most references are to the standard pivot. And that's where you're going to have the most conviction, because it's really going through an area of resistance, and now it's into relatively fresh high ground, and that's fine. But if you want to get to the next level and get a little bit of a head start on everybody else and have a lower cost basis to be able to pyramid, if you're going to be doing that, you want to try some alternative pivots. So one alternative pivot is right here. We call that one a prior resistance pivot. So you're looking for an area where it hit resistance. Remember, resistance is where a stock runs up, comes into some selling, goes down, and then the bottom is support, the top is resistance. So you're looking for an area of resistance in the handle for it to clear. And here is 58.88 was your area of resistance. And a little story that Bill told me, he was actually buying the stock here. He wasn't alone. Another great trader, Gerald Loeb, was buying it there. Has anybody read Gerald Loeb's book? It's one of Bill's favorites, Battle for Investment Survival. If you haven't picked that one up, you definitely want to get that. So he had read it, and he ended up meeting Gerald Loeb at one point. They were in Bill's office, and they were talking, and they were just kind of reminiscing about old trades, and somehow they got on the topic of Chrysler. And it turns out they both had just very keen memory that at this point there were 15,000 shares offered right there. There's a bid and an ask, so offered at the ask. 15,000 shares back in that day, that's a lot of shares. And Bill went in and he bought 5,000 shares of it. As it turned out, Loeb bought another 5,000, and then someone else bought another 5,000. They didn't know who that was. So you have the two best players out there buying the same stock at the exact same point, and that's what they were using. They were using the prior resistance area. And this is right after the Cuban Missile Crisis. So you had a Cuban Missile Crisis over, you have a follow-through day, and the next day they're in there stepping up and buying. And just imagine the mindset of going through that time frame. The Cuban Missile Crisis is before my day, but I'm sure many of you probably remember that. And that would be very, very stressful a few days later after that's over to be in there buying. But that's what you have to do. If you've got to follow through, you need to turn off the emotion and just go to reality. If there's a chart there, you want to be buying it. And that's what Bill was doing right there. Now, another note on a crisis. This is something that I've picked up over the years, and it's very helpful. When a crisis ends, whatever it is, whether it's financial related, if it's terrorist related, anything at all, where everyone is worried about, there's tons of emotion involved, and the stocks are all going down. On that day where it breaks and things turn and rally up, you want to run screens on that day for the stocks that went up the most on the biggest volume. That's very important, and that's going to be a special list that you should keep on your monitor or in your daily graphs if you use it. And it doesn't mean you're going to buy all those, but that's a very, very important list. And look what was happening here on this day. This massive spread closing up there. Because what's going on? All the people who had on their little shopping list their favorite stocks to buy, that's the first thing they're going in to buy. Okay? Just like all of us, if we were out of the market and we were going back in, I'm sure you have your favorite stock that you want to go back in and get your position in there. And I can probably guess what stock that is for most people here, because we're probably all trading the same thing. Anyways, so on that day, you want to have that list and just watch those. And as those stocks set up, that's what you're going to be wanting to buy. And the other thing is the people who are shorting and who are really aware of the reality of what's going on and the dangers that they have on the shorting side. Has anybody ever shorted here? Okay, where you're making money on the downside? If you do that, you're very aware of the downside risk to that. It's a very risky way to trade. And so you're going to be in there buying up those stocks that you know are really quality stocks as fast as you can so you don't get squeezed. So they're in there buying and pushing that up. So a couple very important points. So that's a prior resistance area. Now let's go into another one. This is on page 9. There's two of them here. One is a downtrend over the entire base structure. So what you can do is you can take a line pen. How many people here use daily graphs? Okay, that's what I thought. In daily graphs, you just take a little line pen, you draw it along here, and you just make a tangent with the peak there at 60. And so once it penetrates that, then that's where you can be buying it. Now, the most aggressive way to do it is a downtrend pivot in your handle. So let's look at that. That's this little green line we've got. And not all handles will have this. If your handle has a clear area of resistance that you can draw a downtrend on, which this one does, then you can be using that. Now, we don't have the exact measurement of what the percent of the angle is, but I can tell you if it was coming down like this, that would be too steep. If it was, over here, that would have been fine. So let's imagine that you're in the market, and let's just say you weren't in a bear market, which you were at that point, and you were in the stock right there, okay? You would have drawn a downtrend right there, and you would be buying it here. Okay, so I just want to share with you the risks of these alternative pivots because there's an upside and a downside. Yes, sir?
2 slides ago, the question when you had a follow-through day, what exactly makes that a follow-through day?
The question, if you can't hear, was what makes that a follow-through day on this chart here? There was a follow-through day on the general market. There's no follow-through days on stocks, only on the general market. So I should have clarified that. What happened is the Cuban Missile Crisis ended, you hit bottom, and then a few days later you ended up having your follow-through. So moving on back to this, if we were over here, right, so we're buying this stock. Well, if you're using an alternative pivot, you want to know what the downside risk is. The downside risk is you can have a lot of alternative pivots that do not work out, and you need to know how to handle them. If you wait for each one of these to be down 7 or 8%, you're really going to end up chopping up your account, and you're going to do a lot of damage. Okay? So you need to be aware, if it's going through an alternative pivot, you don't want to give it as much room as you would normally give it. So by this time, maybe on this day here, I would be out of it realizing that, okay, I was a little bit early on this. The stock just isn't ready. I'm going to have to buy it when it does set up. So if you use alternative pivots, I would really highly suggest that you do a lot of study work. You've got a great resource, your Chart School book. There's tons of cups with handles in there. I would go through it and mark all the alternative pivots. In the early alternative pivots, like this one, before you go and put it into practice, because you want to know at what point are you going to back out of the trade before the 7 or 8%. So that's very, very important. Yes? You brought up a very great point. If you couldn't hear it, she was referring to the double bottom that is a portion of this larger cup with handle. And remember on that first chart I showed you, the Tennessee coal, where you had a small cup and handle within a larger cup with handle, or you were saying maybe it's a double bottom, that I mentioned that you see that a lot of times. And in the models, you'll see cups and other bases within bases, and that's a very good point. There is a double bottom here, one bottom, two bottoms, and then you could be using the alternative pivot right there, the prior resistance, where you're buying it through the middle of the W, which we're going to get into that in a little bit. I'm very glad you picked up on that. All right, so just to recap, before you go out and start using these alternative pivots, they have a huge advantage. You've got a lower cost basis. That's great. We all know how that's going to help you kind of ride out some shakeouts. But you really need to know what you're dealing with, because a lot of these don't work, and you need to be able to back away and be able to be very nimble. So if you're not nimble and you're a little bit slower of a trader, which there's nothing wrong with that, you want to stick with your standard pivot, which is your horizontal line there. You just buy it there, and you just kind of forget about the stock. But if you're a little bit more nimble, you're a little bit more aggressive, you want to be using an alternative pivot on some of them. And the other thing you'll do is you'll go through and you'll start getting a feel for where is that line too steep, meaning this line right here. All right, so let's move on. This is on page 11, cups without handles. Now, we don't see a whole lot of these, and I actually find this the most difficult in reality, because you don't know that it's going to be a cup without handle. There's just really no way to know that. Most handles form below the left side high. So most handles would be over here, but some of them are what we call high handles, where they do form over here. And we haven't been able to find a way to say, okay, this stock is penetrating through the old high there, and it's just going to form a handle. So you have to step up and just buy the stock as it's going into new high ground. I find that very difficult for myself personally. Yes, sir?
In that situation, then, would you do your position sizing smaller just in case you do get the handle?
Okay, that's a great question. He was asking, would you do a smaller position size over there? And the answer is no. After lunch, I go into a little bit about money management. And one of the things that Bill has us do, and there's a whole section on it at our level 4 that we go into, every position should be the same amount regardless, because you never know what your best stock is going to be. Like going back to that Bethlehem Steel, you could rationalize, okay, this is a very risky stock to have, a huge move. It might not work, so I'm going to buy a smaller amount, and then the stock has a huge run. So we always like to buy the same size. The only time where that is a little bit different is if you're running a large account and just for liquidity reasons, you just can't buy that. Some of you might be in that situation. Maybe you're trading other people's money, a hedge fund or something, or you just have a very large personal account. Then you've got to back away a little bit. Say again? Yes, we do pyramid. we almost always pyramid. And when you're buying a position, in a nutshell, you're buying 50% as it goes through the pivot, then it goes up another percent or two, you buy 30% more, and then it goes up a little bit more than that, and you follow up with the last 20. So we call it a 50, 30, 20. So you're letting the stock prove itself up, and that's your initial, some people call it a pyramid. Now, the true pyramiding we go into after lunch, and there's a lot more involved with that. Yes? Sometimes a cup can be 6 weeks. It's more on the rare side of things. The first week down from your closing high is your first week in the base. I have an example of that, a perfect example in about 2 slides that'll show you that. Yes, sir?
Situation with no handles. Can you also look at the volume, see when it spike up?
Okay, the question is, would you look at the volume as a predictor as it's going through? Of course, you're always looking at the volume. On the breakout, you want to see at least 50% above average. And so that, if it's not there, you're going to step away anyways. But if it's there, it gives you a little bit more conviction. But still, if you study enough of these cups with high handles, and we have some in the workbooks, and you should create your own little models too of things, you'll find that lots of times there will be a lot of volume there because it's going through into a new high ground. So whenever a stock is going into a new high ground, you do get people, not just people like us trading our system, but other technical-based systems that are going to be buying it there. So you get the volume a lot of times, and you don't always know. Yes, sir? The fact that it's a relatively new issue, that's very, very important. I have a section in a little bit about initial bases, and this isn't exactly an initial base. This is over here, but we treat stocks that are near a new issue in a different way. Those are kind of special case stocks. That's where a lot of your potential is, and that's where most of our trading, we try to go towards those. All right, so let's go into breaking down a stock week by week, and I think that'll answer a lot of things for you. So on page 12, we have Admiral. This is in 1965, but imagine you came across this stock on a weekend and you're wanting to analyze it in detail. I mean, I can tell you since 2000, I've been talking to Bill every Sunday night about charts. And so I'll come up with charts and I'll call him up and we'll go over stocks. So I've gone over literally thousands of stocks with him in detail. And what I'm going to do is I'm going to share with you the way he goes through things and the way he's taught me how to go through a stock. And hopefully you'll gain some information from that. So what he'll do is, let's say I came to him with this name and I said, we should be looking at this to put on our list. We have a list that we sell to institutions, and it's what we can trade off of at the firm. Well, first thing he would do is look at some of the basics. Do you have a prior uptrend? So do we have a prior uptrend? Yes, right? So you got your prior uptrend, and we want to see that at least how much? 30%. Okay? So then we need to identify what type of base pattern is it? Cup with handle, and is it long enough? So visually you can see it's long enough, but how you know that is, as we talked about, starting with your first week down off your closing high. So here's your closing high, there's your first week. So the gentleman was asking about a 6-week cup, 1, 2, 3, 4, 5, 6. So if it was only that long, then it would have been fine, because you start it there. You do not include the pivot week as part of your base count. Okay, so that's important. So you don't count this week and you don't count this week over here. Going through that, so your base ends right there. And then the first thing he would typically ask me is, what's the blue count and what's the red count? And that means blue weeks on above average volume and red weeks on above average volume. That's not the holy grail, trust me. It's just another piece of information, like what the accumulation distribution rating is, or what the RS number is, or the EPS number. It's another piece of data. And so we've got 1, 2, 3 weeks within the base on above average volume. Remember, that's where you don't count the pivot week. And then we've got 1 red week on above average volume. So we've got a 3-to-1 ratio, so that's good. Anything better than even. So 3 and 3 would be okay, but you want to see more blue weeks than red weeks. The next thing you want to do is, as we're going through this, you would look and see, where did the stock close for the week? A lot of our analysis, when we do a week-by-week analysis, is based on the spread the distance between the high and the low, where it is within the base, but a lot of it relies on where did it close within that week's bar. So if it closed at the peak, we would refer to that as a 100%. If it closed at the bottom, that would be 0, and if it closed in the middle, it would be 50. So why this is important is Bill did a study many years ago where he found that as a stock is coming down in a structure and it has a pickup in volume and it closes at a 40% or higher, meaning right about there, a little bit less than mid-range, that is a sign of support or accumulation. So once again, as the stock is coming down and it's a red week and it's got volume and it closes at 40% or higher, that's actually a positive sign. Most people aren't going to get that. Well, typically above average or at least higher than the prior week. The more volume, the more meaningful. The thought process is heavy volume without further price progress on the downside. So the heavier the volume you have, the better off you are. And the higher it closes up in that range, the better. But the lowest point where it's really relevant is 40%. So that's actually very important. All right, so now let's go through it week by week. This is what Bill does, and this is what you should do. The way I do it is I print off the chart, and I'll take two colored pens. I'll take a red pen and a blue pen, and I'll be marking the stock up. With anything negative, I'll mark it with a red pen. Anything positive, I'll use a blue or a green. And then when I'm done, I can kind of look at the chart and see, okay, well, what do I have? What's the most prevalent on the piece of paper? Is it red? Is it blue? And I find that very helpful. What you might want to do is use the annotation tools in Daily Graphs because then it'll stay on the chart. Does anybody use the annotation tools in Daily Graphs? It's really helpful. That's probably the better way to do it, but I've just been in a habit of marking it by pen, and that's the way Bill does it too. So as you're going through, you're making your positive or negative comments on it. So your first week in here, what does that tell you? This week doesn't really tell you much, to tell you the truth. It closes at the low, but you're looking at your volume always. This is the most critical thing. Volume in relationship to what's happened so far. So this is your first week, so you don't really have much of a point of reference. So then you have to go to the average volume. So it's less than average volume, and you always look at the prior week. And so it's significantly less than your prior week. So even though it closed at the low, you're looking at the context saying, okay, in relationship to that big move, it really wasn't that much of a move. So it's just down a little bit. So I'm not going to write anything about it. And some weeks you just don't write anything about it. It's just neutral. Then the next week, you've got low volume, but you closed almost unchanged. And we call that tight. So you know that we typically look for 3 weeks or more, but we do note whenever there's a tight area. So even though it's 2 weeks, I would be marking that. I would be circling that with a blue pen and saying that's a positive characteristic. Your next week, you pretty much, it's just putting in time. And that is constructive. It's just going, it's just kind of there. It's the same high and low of the prior week. There's no price discovery. It's not going into, a higher high or lower low. It's just kind of putting in time on low volume. So that's constructive, but not constructive enough to make any marks about. Now, your next week, what would you say is good about that week? Nothing. Once again, on the percent numbers, 24% is the relationship of the close from the high and the low. So if that closed at the high, it would be 100%. At the low, 0, and the middle would be 50. So 24% is saying it's a bottom quartile. So that's where the close is in relationship to that one price bar. Anytime the stock is coming down, could be in the handle area, could be on the left side, it could be, if it's a big base, could be on the right side as it's coming down in an area. So as the stock is coming down, you're looking for a red week that closes at 40% or higher on a pickup in volume. So you're having heavy volume without further price progress on the downside. So this one, there's nothing good about it. So let's go through everything that's bad about it. We look at the spread. The spread is the distance between the high and the low. And that's larger than any other spread in that base. That's negative, okay? Because it happened on a down week. Then it crashed through support. First supporting area was this area here, you had 2 weeks where you didn't really discover any new ground, and it crashed below that. And then the most obvious is this 50-day line, or your 10-week line, since it's a weekly chart. So that red line. So it crashes below support, and you have a pickup in volume. Notice that volume is higher than any week in the base. So you're always looking in context of, as the stock is going along, is this the highest volume in the base at that point? So you've got your highest volume in your base, you've got a large spread, it's crashed through both areas of support, and it closes in the lower half. Now, if that would have had all the same characteristics, but it closed back up, it would have been constructive. 40% or higher would have been constructive. If it would have been able to go back above some supporting area, like the 10-week line, it would have been much better. But it didn't. So that's a big negative. So you're taking a red pen on it, on your chart, and you're marking that as a negative. It doesn't mean you don't buy the stock. Every stock is going to have positive and negative characteristics in it. But you're trying to weigh things out. So now the next week. So what do you see there? We closed at 52%. So that's our first week where you've got that 40% or more closing range. So you can see that's a little bit more than midpoint. And you've got relatively high volume. You'd like to see actually a little bit more volume. So that's a positive. Most people, they would be looking at that and saying, okay, well, it's down, so it's negative. But look what else was going on. This is something that Bill always pays attention to. The price changes from week to week. So he'll say, okay, the stock from this week to this week came down a little bit. Then it came down a lot, okay? From this close to this close, it came down a lot, so that's very bad. Then it didn't come down that much, okay? So you've got a lot of volume, and it's not really closing down that much, so that's another positive sign. Then your next week here, this is good. It's just biding time. We would call that an inside week, meaning your high and low is contained within the high and low of your prior week. So didn't discover any new ground price-wise, and it's just marking time, and that's very helpful for a stock. If it doesn't have weeks in it like that, the base is going to be very, down and straight back up, or straight up from the bottom. So that's constructive. And notice there's just no volume that week, just kind of dried up. That's very good. Now the next week. Yeah, the very good question. You dropped a lot price-wise, plus you closed at 4%. But the fact that it was an inside week is helping it out on basically no volume. The volume is really what throws me over on that as a positive week. If you would have had a fair amount of volume on that week, I would have said that price move being down would have been more significant. So this week, what's bad about this week? Nothing. Okay. Yeah, it's a perfect week. This is how you would like to have every base look like this on your bottom week. They're not all going to look like this. But if they do, it's a very, very positive sign. Let's just go through all the things it's doing, because it's doing everything right. It's shaking out, so you've got this big spread closing at the peak, so it got rid of all your weak holders, so now you have fewer weak holders in the stock. So on a supply-demand basis, you get all those weak people out, so the people who are holding on to the stock don't want to give it up. So your supply-demand is now in a positive direction. It was able to crash through all areas of support, bounce off your black line here, which is your 200-day or your 40-week moving average, and was able to close up too, making ground. And you've got your highest volume in the base, and it's above average. So every part of that week is positive. Yes, sir?
I understand all the positives you're highlighting. Would you have preferred to see it be a very...
No. No, the question, if you couldn't hear, was would you look at this and say, would you want it to be a tight bottom? In this particular structure, no. A lot of them will have that, and it just ends up being, something that's just not a positive characteristic. It just depends on how it happens. The first chart that we looked at along the bottom, the Tennessee coal, it had some tight areas. So you had 3 weeks tight. That is then a positive sign. This having a shakeout is positive. So it just depends on how it happens. But if that was just like a nothing week there, let's say that low didn't exist and it was just from here to here, that would look funny with that much volume. It wouldn't look right. I would be very suspicious of it. So you're always looking at your volume in relationship to the price move and saying, does this look normal? Is there manipulation? Not illegal manipulation, but people kind of messing with the stock. So let's look at the next week. Here's an example. You've got this great price move. If you just looked at the price and you didn't look at the volume, this would look wonderful. You got kind of a follow-on from your prior week. You move up a fair amount. You close up in the upper portion of it. But look at the volume. It's your lowest volume in the entire base. So there's no confirmation there. So I would either be marking that with a positive and a negative, or I would just be noting that because that's not what you'd like to see. The next week, this kind of got stuck underneath your 10-week line. It kind of has a feeling, a price feeling of churning, meaning it's going up and it can't get anywhere. But on the positive side of that, once again, now you've got the lowest volume in the base. So the volume on both of these weeks is not confirming the price action, so I'm not as worried about it. So if there was a pickup in volume, let's say this volume here was higher than that volume or it was up there, that would be very negative because it's getting up there and it can't go anywhere. It's churning and it's going back down. So it's just essentially what it's doing here is just marking time. It had this big shakeout. Now it just needs to put in its time. Here, just a kind of a nothing week again. It's good that it was able to shake out below those because that gets rid of any type of wedging type of feel. A wedge is a negative thing that happens in a base where you just kind of move up without undercutting the lows of your prior weeks, and that's something that doesn't shake people out, so it's a negative. So this was able to counteract that. If it would have just kept on going higher, you would have had a wedgy type of feel, and that would have been negative. So that shakes out below there. You got kind of a nothing week, a little bit of a pickup in volume, but stuck underneath the 50-day. And then now you've got a good week here. Big spread, looks very similar in character to this week over here, closing at the highs. So now you've got another very positive thing that you're marking on your piece of paper. Next week, same thing. That's what you'd expect to see. Highest volume in the base as it's getting, around this area over here. Then we've got our handle. Now, we always say we like to see a dry up in the handle. Now, this is above average volume, but you want to put it in the context of the prior week. So your volume did come off a bit, but it is not the 40%. So it's slightly negative, but in the context of that chart, it looks fine, nothing to worry about. Then you break out. So if you had that piece of paper and you'd marked it up with all the different things with a red pen and a blue pen, you'd see the vast majority of that was blue. So is that stock under accumulation? Well, you would say yes. So now let's look at it on a daily chart.
Why don't we use candlestick instead of, but you don't know where the week opens. Why wouldn't you use the candlesticks?
If you couldn't hear it, why do you not use candlesticks? Bill likes to keep things very simple. He has personally studied candlesticks and he doesn't like it. Everything on our charts is what Bill likes. I use candlestick charts on my intraday charts that I use following stuff. I find them helpful. I can tell you out of the 8 portfolio managers we have, I'm the only person who uses them. And Bill doesn't like me using them. But he also says if it works for you, then use it. Bill's done all right for himself and he hasn't used it. So, But if you like it and it works for you, because I know what you're talking about, the open is helpful for me. But he keeps things simple. If you look at our charts, there are a lot of things that we could put on there. We could put Bollinger Bands, we could put candlesticks, we could put all sorts of Fibonacci stuff, lots of stuff out there that a lot of people use and make money off of it. But Bill is a simple type of person. He likes to get rid of all the junk and just go to what is the most helpful. So what he uses is a relative strength line. If you notice on our charts, that's really the only thing that we have on the chart. And so he puts a lot of weight in it. I put a lot of weight in it. It's the most helpful indicator. Even though there are other things that you can use, they're not really Bill approved.
So that's a 14-week base with a 2-week handle. That's all you got.
It's a 14-week base with a 1-week handle.
1-week handle, just the one down.
Yes.
Okay.
Yeah. And this is very typical of a base structure where they tend to fall in about this size. That's why we went over it. This is, your typical base. And what happens is, most of the time, you'll have an earnings report somewhere over here, kind of just consolidates that, and then you'll get an earnings or something that tends to drive it. So here's the relative strength line. This is on a daily. So the blue line is your relative strength line. Now this is very important. You want to understand what this relative strength line is measuring. So it's the relationship between the general market and the stock. So by definition, it tells you, is this leading or lagging? So you want to understand the movement of any one day, just so you really get the concept. If the stock is up 1% and the general market is up 1%, what do you think that line would be doing? Sideways, absolutely sideways. But if the stock is up 2% and the market's up 1%, it's going to be up slightly. The same thing in reverse. So over time, any one day's move or even 1 week's move is not relevant. You're looking at the trend of it, and you're looking at the relationship between the line and the new high ground of the stock. That's very important, because that will dictate, is the stock leading or lagging. This past week, we had Google have some problems. And if you looked at that, it had built a cup with handle. But if you looked at the relative strength line, it was very, very bad. And it was telling you ahead of time that this stock is lagging. Now, it could have had positive news and gapped up. It's just one indicator, but it's a very, very good indicator. So looking at this, what I like to do is draw a line on here when it goes into new high ground. This is an extreme example on the positive side, where this relative strength line goes into new high ground well before the price goes into new high ground. So see, right, if you draw a line up here, right about here, this relative strength line is leading it into new high ground. Very, very positive. They don't all look like that. If you see something like that, you really want to pay attention to it, because this is a leading stock. Now, most of your stocks are just going to follow what the general market does. So if you look at the market and it's up 1% for the day, you look through the database, most stocks are going to be up. And same thing on the downside. So this is outperforming it. Very, very important. That's what you want to pay attention to. Now, another thing, on a daily chart, this is about the only thing that Bill has taught me on a daily chart, because he really uses weekly charts almost exclusively. I use both daily and weekly, but he uses probably 80% of the time he uses weekly charts. We also use monthly charts and intraday charts. Each one serves its own purpose. But on a daily chart, what he points out is on the bottom day, if you've got this type of action here, let's blow this up and look at it. Very similar to what happened on that bottom week, where you have the highest volume at that point in the base, and it closes up. He pays a lot of attention to that as a positive sign. That does not mean that all bases have to have that. It doesn't mean that all of them that have that will work. It's just like any other positive characteristic. So what you're trying to do is you're trying to have a database in your mind of all the positive characteristics and all the negative characteristics in a base. You put all the pieces together and you say, okay, looking at this on a weekly chart, we had more blue weeks than red weeks on above average volume. The base was the proper length. We did our week-by-week analysis. That was positive. We've got a very strong relative strength line on here. On a daily, we've got another positive thing. So that gives you conviction to step up and breaks out here, and you're stepping up and you're buying it, because you want to have some conviction before you put in your hard-earned money at risk, because, it wobbles around for a little bit, like this day. That's what's going to get you through something like that. But if the chart just looked mediocre and it tried to break out and then immediately it kind of reverses and has one of these days, you might be more inclined to start backing away from the position, but not with a stock that's looking this strong. You're going to give it some more room. So obviously, we can't go over every chart in the book in this type of detail, but I wanted to go over one of them like this so you get a feel for what Bill does. And this is what we do with every stock that we're looking at. And that's just the technicals. Then you have to look at the story. That's very important to him. He reads the New America stories more than anyone in the building. That's a fact, because we get a little record of what everyone pulls up, how many charts people pull up, how many stories people pull up. So Bill is always reading those New America archives. It's very, very important. And then all the fundamentals that we just can't get into today. So now here's page 26. cup without handle. There's really not a whole lot to say about it. You're looking at the base, page 26. You're doing that work that we talked about, and it's a completely different structure, and you're having to just kind of step up and buy it as it goes through that 13-13. These are very hard for me. They might not be hard for you. Everyone on the team of portfolio managers, including Bill, we all have our different strengths and weaknesses, and it's very important that you know where your strengths and your weaknesses are. And you should make a cup with handle one of your strengths. That should be, at the core. If you're not very good at ascending bases or cups without handles, well, that's probably okay because you don't see a lot of them. Flat bases and cup with handles you see all the time. All right, so let's move on to page 47. Here is a cup with handle, a more recent one. This is SunPower. And I just wanted to share with you another example of an alternative pivot. So as you're going through, you'd be drawing that downtrend line here, and you're buying it right there as it penetrates. So imagine if you're going to pyramid this stock later, having that lower cost basis is going to help you a lot. Those of you who pyramid, the alternative pivot is more important. If you don't pyramid, meaning you just buy the stock at the standard pivot and you leave it alone and then you sell it when it's time to sell it, well, then that's fine. I would just use the standard pivot because it's not going to give you as much of an edge as worth the trouble. So those of you who are pyramid, it's very important to keep a low-cost basis, so that's what I would be doing there and stepping up. Now, the reason why I brought that up is here's another example. This is what I would like you to do in your workbooks when you go home over the next month or so, is go through and say, okay, if I was in it or looking at the stock, I probably would have drawn a downtrend line here. Let's blow that up. And would have been buying it here. And you just have to ask yourself, at what point are you going to say, enough is enough with that stock and you're going to back away? And everyone's going to have a different level. You might come up with 2% or 3%, or you might find a time frame. If you're not up on the stock within 3 days, you're going to back out of it. Everyone is going to have a different risk tolerance and a different amount of trading that you do activity-wise, so everyone's going to have a different answer. I can tell you, I would be out the next day because that big of a spread closing near the lows, that's not normal after an alternative pivot. It should do something more like this. So I'm backing away knowing that I'm just early on it and I'm just going to watch it, and it doesn't give you another chance to get in it until over here. Some of them give you a fair amount of chances, and you can get really chopped up if you're not careful. Yes, sir?
Your comment connecting the pivot point, the alternate pivot points to whether you're pyramid or not.
If you're doing a standard pivot, you might as well just wait for that standard pivot because they're going to work more times than an alternative pivot. Because alternative pivot, you could have 3 or 4 alternative pivots before the stock really goes through. And the advantage to the alternative pivot, the whole reason why you're doing that is to get a lower cost basis to handle the shakeouts. And if you're just buying it right here and you're just sitting with it, then that's not as important. You're going to be able to sit with those shakeouts easier. If you're pyramiding, adding more and more shares as the stock is going up, by definition, you are raising your cost basis. That becomes very important, and it's very easy, I speak from experience, of getting shaken out of a stock because you've run up your cost basis. So that's where, if you're pyramiding, I would look at alternative pivots. If you're not pyramiding, just wait for that safety of a standard pivot. Sure. We do it the same way that we would do it now. You buy 50% as it's going through the alternative pivot. It's up 2%. You buy the other 30, and then it goes up another percent or so. You buy the last 20. Nothing changes at all. This is page 49, Apple. Anybody know this stock? Ever heard of it? I'm sure we've all had lots of fun trading this. Good stories, bad stories. But this is how it started out. You should go back and you should study this because this was not a perfect chart. Okay? It looks perfect now if you see how much it went up, but there are negative things and positive things in there. And we wanted to include that because it's such an important stock that we've all traded. I have a position right now. I'm sure most people have a position. I just have to disclose that if I'm talking about a stock. You've got to look at reality. And this was not as easy as it seems, but you did have a lot of positive things in there, one of which, just like Tennessee Coal and Chrysler, you had a base within a base. So you have this larger cup with handle and this smaller cup with handle in here. So you should study that when you get home, because when the next one of these comes along, you want to know what reality is. Let's move on to MicroStrategy on page 57. I include this one in here as just kind of a reminder of my mistakes. You should do a post-analysis at home. How many people do a post-analysis? Okay, that's good. That's a fair amount compared to normal. It's one of the most important things that you can do. So at the end of the year, study your winners, your losers, and write some rules around that. This one, I messed up. This is back in the crazy 99 time frame. So this is one of the only charts we have during that time frame because there's not a whole lot to learn from those because they were all kind of wild and crazy, just like 1929 charts. And I looked at this and said, oh, I'm smart. I know what to do. I'm going to avoid this stock because it's V-shaped. And what I didn't do is I didn't do a further analysis and look at it on a week by week and see that, okay, this came down 49% closing range. And each one of these in there was really kind of a supporting type of feel, even though you didn't have the volume with the rest of them. And I missed out. And see what I missed out on? That. So every day, even though 99 was a very, very profitable year for me, like I'm sure it was for everyone here, this is like the first chart I'd pull up every day. It killed me that it went up this much. So that's why we have the apple in there. You want to look at every part of a base and don't just make a quick judgment that there's one faulty thing wrong with the base. Once you start, having 2 or 3 material things wrong with the base, then you probably want to pass it up. But one thing is not enough. Next is saucer with handle on page 71. There's really nothing different about a saucer than a cup. It's just over a longer period of time, and it's a little bit more shallow. If you were to look at this and say it's a cup with handle or a saucer, it does not change anything about it, nothing about how you trade it. The only thing you'll notice is that saucers tend to be more of your slow, pokey type stocks. And that's important to have stocks like that in your portfolio. RJR, back in 1960, had its little saucer with high handle over there. I will point out, I don't want you to go to it now, but if you ever wonder, what happened to all of these stocks, like how much of a move did they have, we've added in your workbook, all these examples, we have what we call the aftermath or the subsequent price move in there. There's a little chapter in there. So you can see the entire move, which ones had monster moves, which one has a little bit of move. And we find that very, very helpful. And you should study that area too. Now let's look at double bottoms on page 77. Now this is a very violent pattern. Some people refer to it as a W because of the way it looks. Let's take a look at one. You want to have the second bottom undercut your first bottom. Okay? That's going to shake out weak holders. And where you're buying that is as it goes through the middle of the base. Some of them will go up a little bit, form a high handle or another handle, and you have 2 entry points. You can have your standard pivot going through the middle of your W and then a handle area. But you never know if it's going to form a handle or not, so you need to be buying it right there. So here is a double bottom. This is a little bit unusual because it took several weeks to kind of get under there. Most of them, they kind of just shake out and go right up. Let's look at this on a daily. This was Cisco. I did something with this that I would suggest that you guys do. Find a stock that you don't want to miss the next Apple or Cisco for me. And I printed out this on a big piece of paper and I stuck it up next to my desk, and I had it there for a year or so, and I just studied it, and I said, if the next one of these comes along, I don't want to miss it. So how do you get into this? Because this was very, very difficult. We all know what Cisco did. It had this massive move, but this was not an easy stock. The more you look at this, the more things you'll find about it. But the most relevant thing is how do you get into it? And I'll share with you the way to get into this one is using the shakeout plus 3 rule. Something we don't talk a lot about. It's something to have in your toolbox. Maybe you use once a year. Some years you don't even use it at all. What it is, the stock is forming a base. and it hits a low, which is 22 here. Then it shakes out below that and immediately turns and rallies back up. If it goes 3 points above that low, that's where you can be buying it using the shakeout plus 3. So here's your shakeout. You add 3 onto that. You're buying it right there at 25. There's not an exact time frame on there, and we tend to use the 3 points for stocks between $30 to $60. So a number of years ago, Bill tried it for Google or one of the higher price stocks, and he kind of adjusted it on a percentage basis. And back in the day, he used it, I think it was for Pick and Save, and it was $15, and so he used $1.50 on it. And this is out of the Livermore book that Bill pulled it out of. This is something to have in your toolbox. Once again, if you don't get this down and this is difficult for you, don't worry about it. You're only going to use it every once in a while. The cup and handle is what you really need to get down. And here's another example of a double bottom. Here's Nokia. And what's important here is that this is a weekly. This is on page 90. That relative strength line held up right there. So the stock was coming down, and it's showing strength. Okay? And so you had your shakeout, goes up. You can be buying it right here, and then you can be buying some more right up there. So here's your one bottom, two bottoms, the shakeout there, buying it, and buying it through the handle. And that's a 68% closing range on enormous volume. So that's a classic sign of a heavy volume without further price progress on the downside. All right, so let's go into flat bases.
Before you answer that,
Sure.
would you also use a trend line on this and get an alternative?
Very good question. I've never had that question before, and the answer is no. The question was, can you use an alternative pivot on a double bottom? We don't use that. We've never studied it, and I wouldn't advise it. But it's good. But with anything different, if you have some sort of idea, what you do is you go home and you build models of it, and you study it, and you come up with your own rules. That's how you progress. So let's moving into flat bases. Flat bases, this kind of looks like a boxy base. You know, Bill has put in his new book, the boxy pattern can be as short as 4 weeks. Typically a flat base we would normally look at as 5 weeks, but he's studied some of the boxy patterns. Boxy meaning it just looks like a box going back and forth, saying they can be as short as 4 weeks. But you look at them the same way. You're really looking at just an area of support and resistance. Stock is just kind of going sideways. They're typically a second or third stage base. And so it's going back and forth, and then it's penetrating through, and you're buying it. So let's look at an example. Here's dry ships on page 101. It runs up, breaks out, and you're just stepping up and you're buying it right there. This is as easy as it really gets with trading. You're just buying it as it goes into new high ground. I'll show you one that's a little bit more difficult. This is Reynolds on page 103. This is where flat bases are tricky. Sometimes, because everybody knows how easy it is and everyone's just buying it as it's breaking through resistance, you'll get people buying it a little bit early and then it shakes out. So this is where it becomes a little bit more tricky, and you have to decide which way are you going to play it. Now, this is a very extreme case and almost a little bit too extreme, but we just wanted to kind of have an example of showing you what will happen a lot of times, because everyone knows 79.25 is the area that, you know, a lot of people are going to be buying it, so they'll try to push it through there. So if it goes and sets itself back up, you can either be buying it if you're aggressive back through the original 79.25, or if you're a little bit more conservative, waiting for whatever your actual high was there. Once again, this is kind of almost like a cartoonish type of example of that, because typically it'll just go up to maybe like 79.50. You know, just go up, but just a little bit, come back down. But we wanted to share with you the tricky part of flat bases. So let's move on to an ascending base on page 128. Now, ascending bases, that's something that you're going to find near the middle to end of the move of a stock. And that's why it's important that we have the subsequent price moves in your workbook. So afterwards, when you go home, you can study, you can see, yeah, most of these ascending bases happened the second half of the move or even the tail end of the move. So that's important for you to know if you're trading one of these, that if you buy it, which you should, because it's a very powerful pattern, but you want to be looking for the exit sooner than you would if you're just buying any other stock. So what is an ascending base? An ascending base is a little bit different than most of our bases, where it's actually going up into new high ground throughout the base. And you have 3 pullbacks. 1, 2, 3 pullbacks. In each one you go a little bit higher. This time frame is typically about 9 to 16 weeks in here. In each one of these pullbacks, it should be relatively well contained. And most of the time, not all of the time, but most of the time, the first 2 pullbacks will be a little bit deeper than your last one. This is just an example where it wasn't that way. But most of them you'd have kind of a deeper, and then just a little shallow thing. And you're buying it as it goes into new high ground over the third one. These tend to happen while the general market is going through an intermediate correction. So let's say you have a real leading stock, the market starts going through an intermediate correction. It can also be helpful to be aware of what your stock is doing. Maybe you're at this point saying, okay, maybe this is forming an ascending base. So let's look at an example. This is Qualcomm. Back in the heyday, Bill made a ton of money off of this one on page 135. It's just a classic case. Here is your original base, has this huge run up, and then 1 pullback, 2 pullbacks, and here, looking at that last one is just very shallow. And that was somewhat near the end, but it still had a run from there. And here's another example. This is a few years ago, back in 2006. Bill put this on our list that we trade, if I'm recalling it correctly, and he put it on up here, recognizing this ascending base. That takes a lot of guts to say, to an institution, we're recommending a stock that's at 45 that was at, split adjusted, $1 or $2 not that long ago. And I thought maybe he was being a little bit too aggressive, but sure enough, it worked out. He's probably the most aggressive person I've ever come across, and he's just able to make it work. So sometimes they're going to look like this, sky high, and if you look at that and you just can't get yourself to buy it up there, I would not blame you. But I just want to show you reality. Okay, let's move on to a high type flag. We kind of went over this with the Bethlehem, but let's take a look at another one that did something like that. This is Rollins on page 151. Now remember that Bethlehem gave you that early entry point? This one did the same thing, where you've got a chance to get it wrong, then you got to step up and you've got to buy it back right there. And typically you want to see 3, this is a daily chart, so you like to see 3 to 4 weeks of it sideways. So that's a little bit early to be buying it anyways. Here was Syntex. This was what the firm was built off of. Bill's profits from this stock. This was the pill, the original pill back in the day. And so your high tide flag, and he ended up selling it basically on the top day. So let's move into initial bases, because this is important. Let's turn to page 172. The initial base section, they're just standard bases. This is a cup with handle. But we wanted to really emphasize how important it is, because look, it's a standard cup with handle, and look what the stock ends up doing. So you really want to pay attention to these, because our model books are filled with them. That's why it's important to us. We only share with you what we see a lot of, where a stock prices out, forms a base, and then has one of these big moves. This is a standard base, but it's the first base, so we call it an initial base. Most of our stocks in our model books have had an IPO within the last 8 years or so. So not all of them, but the vast majority of them do. So we pay extra attention to these, and we have several examples in there. Reebok is another example. You should study all these, and these are our favorite ones to trade. So if you come across one like this, you want to pay extra attention to it, because people haven't built their positions in it yet. All right, so the sponsorship still has plenty of time to build their position.
Do you consider the prior uptrend? You said it's above.
This little thing I would call the prior uptrend. With initial bases and IPO bases, that's one of the things you don't always have there. You'd like to see if the stock is going to price out at 14, that it starts trading at maybe 20 or something like that. we have some examples right now of that. So let's look at our IPO section. This is something that Charles and I wanted to add to the workbooks because it's something we noticed in a lot of our models where the stocks would just kind of come out, be an IPO, and just have a rapid move. And they didn't form any standard base pattern. The last stuff we were looking at, initial bases, those were standard base patterns, cups with handles, double bottoms, and such. Nothing different about them other than the recent IPO. This is a whole different structure. So we went and studied them, and we looked at every IPO basically in the last 10 years prior to putting this workbook together, every single one. And what we discovered was they were very, very powerful, but the vast, vast majority of them do not work. Okay? They do not work. But some of them work, and they really work. Here's an example. So Apollo, out of that, the chart we were just looking at, does this. So you've got to be aware of that. We have a lot of different examples in your workbook of the IPO bases and how they form. Typically what happens is they price out, they'll go sideways as short as 2 or 3 weeks, and we put the amount of depth on there in all the charts. And before you trade one of these, you need to look and study every single one of them so you understand it. And then you're buying it as it goes into new high ground. Some of the things that you can do to increase your odds on this is look for the underwriters that are doing well at the time. For most of the time over the last several years, it was Goldman Sachs and Morgan Stanley were the underwriters that were getting all the best quality merchandise. And that's something that is going to change over time. And so you want to look at the most recent year or so of the IPOs and see what underwriters had the better ones. Also, the higher the price we've seen as time has gone on, that's also an indicator. It doesn't mean it's going to work out. And of course, you're looking at the fundamentals, but a lot of times the fundamentals will be a little bit difficult to interpret because they don't always give a quarterly breakdown. They'll just have annual figures in there until they start reporting. Yes, sir? I used to, and then you can overthink it. It costs me, selling some stocks early, so I don't pay attention to it just because everyone else knows about it and you figure that it's baked in, but sometimes it hurts you, sometimes it helps you. But I haven't figured out anything that will work more times than not. The difference is, and let's look at a couple of these and you'll see, here's First Solar. There's not a base there. That's why I want you to go home and study every single one of these that we put in there. It is a structure of, an area of resistance. And so we wanted to put some hard ones in there to show they're not all like the Apollo where it just goes sideways, breaks out, and just goes to the moon. There's some of them that you would be buying here, and then you're shaken out of. And then it forms another area of resistance, and you've got to buy it back. Because that's what happens. If you don't trade these, there's nothing wrong with not trading these. This is like alternative pivots. This is a more aggressive way of trading. If you don't buy it there, you don't get another opportunity to buy it until up here with this cup with handle. And if you're willing to let those go, then you're fine. But here's another example. This is Google. Okay? So price out at 85, really starts trading around the $100 plus range, goes sideways there, breaks out. You wouldn't have had another opportunity until over here. Let's look at another one. MasterCard. Here's an alternative pivot. Standard pivot. And look at that run. So we've got tons of examples in there. Charles and I tried to go through and get all sorts of different ones. Adobe, looks like this and runs up. Home Depot is a little bit different. It's way down here, forms a little cup, and then runs up. So that is something that you really want to spend a lot of time going over. But don't forget, most of them do not work. Don't trade more than one of those in your portfolio at any given point in time because they're very volatile and the hit rate is very low.
The mutual fund sometimes are not in at all at the beginning. That's what bothers you when you go in and
The question is about the institutional sponsorship at the beginning. Lots of times there'll just be a lag of the data information, so you don't know how many of them really got a position at the IPO or not. So let's move on to base resetting. You should all be aware of this, but we just wanted to include it in here. because this is important when you're looking at faulty bases. You want to buy first and second stage bases. Try to avoid the third and fourth stage bases. So just always remember that if the stock is run up, it can reset once it undercuts the low of a prior base. Then it becomes a stage 1 again. So let's look at an example of that. Here's Liz Claiborne on 233. Runs up, builds several bases. And you see that there? It undercuts it right there. So now this is a stage 1 base. So it's okay to buy that base up there. But all things being equal, you want to buy it over here. This is kind of fresh meat over here. That's what you want to be. This is your initial base type of area. That's why Charles and I have that whole section in there, IPO bases and initial bases. These are the types of stocks you want to focus on. But they're not all going to be IPOs. And sometimes you're going to have to trade them up here. You just have to know how. You want to wait for that reset. Moving on to faulty bases. This one, I can tell you, a few years back, I asked Bill, I said, you know what, we have all these models of winning stocks. Maybe we should make models of faulty stocks. And he said that, that was not a good idea because he felt that the more faulty bases that you looked at and studied, that would kind of be registering in your mind and you would get mixed signals. And at first I didn't really buy that, but as time went on, I see what he means. Because remember early on I said you're trying to look at stocks and making like a mental database of the stocks that really worked out so you can reference those. And so I think the more time you spend looking at winning stocks rather than faulty stocks, the better off you are. So you don't want to spend as much time on these as you would the other sections in the workbook when you go home. But they illustrate some of the points of the negative characteristics of a base. Let's look at this one on a daily. This is kind of important. The alternative pivot that we're talking about, that line, this is too steep. You were asking about studying this area over here. I would draw a line from here maybe to here, but there wasn't a whole lot of resistance there. So, you might not even put a line here. So the most important way to avoid this stock is not buying it because it never broke out. Okay, so some of the best things to kind of sidestep are stocks that never broke out. Now, there's all sorts of things wrong with it. It goes straight up from the bottom. Look at that. In a couple days, you're right up to the top, so it needs to put in time. And this is a big, big warning sign. You've got the stalling day here. So this looks very, very suspicious. And then, of course, it fell apart. So when you go through that, you can see all sorts of things that are wrong with it. So kind of going back to your point about the prior uptrend, like this stock had lots of things wrong with it. It did have a prior uptrend, but it had, going back to the weekly, 7 weeks down, straight up from the bottom, stock never breaks out, stalling. So you can see that when a stock is faulty, it tends to have a long list of things that are wrong. Here's iRobot. We wanted to include an initial base in here that didn't work out because I just didn't want you to think that all initial bases work out. And so here, you didn't really have a lot of volume in there. And even though it was a great product, this makes the little vacuum cleaners that just go around your house and the little circle thing. I'm sure you've probably seen them at Costco or what have you. We have one. They're great. But great product doesn't make great stock, so you avoid it. Now, here's Cisco. Great company. It already had its big move. And you had your overhead supply right here. See that area? This is where people bought the stock. All those people that bought it, they're waiting for this stock to get back up there so they can sell. So there's a ton of supply right up there. So if this was a year and 3 quarters back, you wouldn't really be applying that. But since it's really very recent, that's a problem. Does anybody see anything else as glaring about this that we've been talking about? The RS line, okay? When you go home, look at these faulty bases and look at that RS line, you'll notice a big difference between the winning ones and the losing ones of this RS line. This is a classic example of this stock lagging. The market's going up, that's why the stock is going up. And here is a stock with all sorts of problems. There's a lot to learn from things like this. We can all get sucked into stories like this because this was e-college back when all those similar stocks were going. But it forms, no matter how good the story is and how strong the group is, if a stock is already run up from $4 or $5 up to $26, it forms a base. Everything better be perfect if you're going to step up and buy something because you're taking on a lot of risk. So what you're trying to do is see, okay, is everything perfect? Charles and I marked a fair number of things, but there's even more things on here than what we marked. And what you might want to do is when you go home, go through kind of the faulty base section as well as the good section and mark the other things about the bases that are good and bad that we didn't mark in there because we couldn't mark every last thing. So I'm sure you'll find tons of other things, but here's an example where the handle is in the lower half. And it never broke out, just like the BSX. All right, here's OVTI. This is a good example that I like to bring because it reminds me to not pay attention to analysts. I come up with this name down here off of this double bottom, and I had a position in it. And we had a very smart analyst at the firm, had gone to a very prestigious MBA school, and he was writing up a story for us internally, and he was saying, how bad this was, which he was right. He was just a year early, and that's why the stock collapsed. So when I read it, I go, wow, this guy is, a lot smarter than I am. And, it was on one of those days where the stock was weak, I sold out. And that's why I like to include it in here to remind myself and to pass on to you. Don't listen to other people's comments. They could be smarter than you. They could not be smarter than you. They could have more information. Do your own analysis, okay, and come to your own conclusion. Because in the back of your mind, if you have someone who said something bad about a stock, and it was at the bottom of this week right there, I said, well, I guess he's right, and sold it and never got it back. So I'm sure you all have stories like that too. So just remember, do your own work. And then what's important up here is it formed a double bottom, like this was a double bottom. But what's wrong about that? Look at that second bottom. Look how much lower that came than that first one. Let's take a look at that. Okay? This is not what you want to see. When you go back home, look at that Nokia example that we looked at in the Cisco example. This is not what it looked like. They were down just a little bit and they turned. This one was down and kind of lived underneath there and then came up. And this was a great story at the time. I mean, I'm sure some of us were trading the stock here, and sometimes you can explain away because the story is so good. But if the base is not right, you want to avoid it, and that's a major problem. And then the other thing is it can't hold that breakout. Here's your double bottom. Your pivot point is right here. And if you have a powerful move like that, if the stock is for real, that stock should keep on going. There should be a lot of momentum there, and that stock should keep going. And so it can't, and you want to back away from it. Because you're going to buy stocks like this, and you're going to make mistakes. Everyone here is going to make mistakes. I make mistakes all the time. The point is you want to recognize those mistakes as soon as you possibly can to avoid ever being trapped in a situation like this. You never want to be in this, so you always want to avoid that. That's why that 7% rule is so important. All right, so let's move on to Palm. Now, what would you guys say on Palm kind of jumps out at you? There should be something that maybe you don't look at now, and it's marked on here. It's probably one of the most important things. The reverse split. So you're dealing with, you're dealing with really low quality merchandise here. It had a 1 for 20 reverse split. So it had, I'm not saying that reverse splits mean the stock can never go up, but that's a defect. There's something wrong with it. And it was able to move up. There was one move in here off of this cup with handle that was good. Here was your cup with handle. You had your nice quick move up there. There was, that's fine. But this whole thing is just wide and loose except for this one area. And then this area is wide and loose. And look at each one of those weeks in there. Your high to your low. Look how dramatic that is. Okay, so if you were doing that week-by-week analysis on this one, the way that we did on that Admiral earlier, you would be coming, up with a sheet of a lot of red and very, very little blue on there, and it should be telling you to avoid it. But what you want to be aware of is there are enough chartists out there that look at this stuff and they don't do that type of work, and they'll buy it, and so the stock will go up anyways. And I get sucked into them most of the time that way, because I'll look at it and I'll say, well, this isn't exactly right, and then the stock starts going, and I go, well, maybe I'm wrong, and I jump in and I buy it. Has anyone ever done that? Yeah, so that's why you want to do your work ahead of time, mark up your chart, have your little list of stocks, and prioritize them. And just say, when the market's closed, look at them and say, okay, this is an A-rated stock, this is a B-rated stock, this is a C-rated stock. Not based on IBD's ratings, but your own rating, your own analysis that you did. So when the market's open and you see the stock going, you're going to go back to your sheet of paper and say, you know what? I said this was a C-rated stock or a D-rated stock. I'm not going to play, and I'm just going to let it go. Here's another example on page 276. Now, this is a classic example of a relative strength line, but I can tell you it was kind of funny. When I was going over this chart with Bill, he mentioned to me, he's like, well, everyone's going to know that that's faulty because it was Ramada, and back in the 70s, Ramada was really kind of low quality, and he's like, don't you remember that? And he kind of forgets my age sometime. Like, well, Bill, the time that broke out, I was probably about a year and a half old, so if I was in a Ramada, I probably don't remember it, but the way that you can tell if something is a leader or a laggard is this RS line. I think the gentleman over there had the question earlier about, is this line leading or lagging, and how do you know when it's beating the S&P? Well, right here, look at that base. That's a pretty looking cup with handle, but a couple things that are really wrong with it. One, it's a base next to a base, this base structure here next to this base, not a base on top of a base. And we'd like to see a base on top of a base. So if this structure were sitting up here, it would be much more powerful and proper. But the overriding thing, and if you go back and you look at Google this week, if I'm recalling correctly, I think the relative strength line looks somewhat similar to this. It had a pattern like this, but the RS line was down there. So if you had done this work, I'm sure no one here bought it, but if you had, you would look and see, okay, well, it's faulty, the RS line is lagging, and therefore it doesn't end up working out. And it's a low handle, so that's a good point. Like I said, go back home and mark all the other things that you see right and wrong about these, and you'll be picking up a lot of things, and that'll be very good work for you. That's what Charles and I and Bill and all the people on the team do with our model books. We take the charts and we mark them up, and that's how you learn. As you're writing the stuff down, it's cementing it in your mind. If you see a chart that's marked up and you don't have to do it yourself, you're not getting as much out of it, honestly. All right, so this is our last chart here on page 277. And with this one, I just want to point out that you see something in here that you haven't seen before, that I haven't seen before. I've never seen this where this week here, where you have the high and the low happens in the same week. So the point is, if you see something that you haven't seen before, you want to avoid it because you don't have a precedent for it. So this might not be the thing that you see in the next stock that you come across. But if you come across a stock and you go, wow, I've never seen anything quite like this. It's very unique. You know what? Just pass it up and then see what happens. And now, if it happens again, you'll have a model of that. So just to kind of recap, we went over the good bases, the bad bases. When you go home, spend most of your time looking at the good bases, look at the prior resistant pivot, the other alternative pivots, the downtrend pivots. Before you do any of your IPO trading, make sure you study all of those and never trade more than one of them at a time.